Are you tired of seeing other traders posting large payouts while you still struggle to get funded? I know exactly what that feels like. Recently, I got funded with $750,000 in just 2 trades. But right before I had a major breakthrough in my trading, I was in the same situation that you are right now. I was investing my hard-earned money into the markets without having a clear trading plan or strategy. I wanted to quit my job so badly that I was chasing loss after loss in the hopes of becoming a full-time trader. That was until I developed a simple strategy that I could follow on a consistent daily basis without doing too much work. And since then, I quit my job, have been trading full-time for the last 3 years, and have withdrawn over $1 million from prop firms. So if you stay till the end of this video, I promise you'll have a clear path on how to get funded and pull consistent money from the markets. Now grab your notebooks and let's get into the video. All right, so let's review a strategy that got me funded with $750,000 in just 2 trades. Now, this strategy I've been using for a very long time. Sure, if you guys have been following me at all, you guys know that I keep my trading very simple. So by the end of the video, you're gonna have an extremely simple strategy with some actual charts that you guys can, easily take this process, go back and back test, and actually implement this in real time. So we're gonna cover a couple different things, which is, I'm gonna try and keep this as simple as possible. That way, you're not overloaded with information. You don't have to review too much information. It really just comes down to you taking this information that I'm giving you and then applying it in the live markets. So the first thing that we're going to just determine, and before we take any trade, really the goal of any specific day trade is to just determine what is the direction of that next daily candle. And that's really all you need to know in order to be able to position yourself in the market. If you don't have that clear indication, then obviously we don't have a trade. But forward it almost as like a coin flip process. You're just trying to determine, is the next 24, is this next session going to trade higher or low close by the end of that? End of that session, is it going to close up or is it going to close down? Really, that's the basics of trying to determine a trade direction, and then execution will get at. So the way I determine daily buys, and I'm going to keep this as simple as possible, the way you guys aren't pulling your hair out trying to overanalyze the charts, because you can put as much lipstick as you want on the charts, but if you're getting confused with having all that analysis, it's going to really hinder your decision making. And the point of this video is to show you need to put a lot of thought process behind my trading. I'm more reliant that I'm following, and then just relying on the probabilities. So when we're talking about the market, is the market creating higher highs and higher lows, or lower highs and lower lows? It's very simple. I've just provided 2 examples that you guys can study here, and I'll zoom in here. And this is just a bullish example. You can see that even with some pullbacks, this is mostly an uptrend. But we're only really focused on what is that next 24 hours going to do. So typically what I'll do is, when I'm coming into the markets and just trying to determine what the next daily candle might do, is a lot of time trying to focus on what is the most likely continuation from the last, say, day or so. So if yesterday was bullish and it closed pretty, like just as an example, you might look at this candle and say, all right, this candle looks pretty bullish. Tomorrow, I want to be bullish. It's as simple as that. I just want to have a clear indication going into the following day. Do I want to be bullish or do I want to be bearish? That's, in a nutshell, that's really all you're trying to do. So here's a bearish example. We can clearly see that the market structure is where it's printing lower highs and lower lows. So all we're looking to do as far as this process is determining what direction is that next candle likely to go, or what is the overall prevailing trend. Is it bullish or is it bearish? And do I want to try and continue, assume that we have continuation plays, or maybe we're going to play a counter trend or a pullback? That's really all that needs to be thought about. So when it comes to thought process, when we're trying to determine a daily bias, don't try and trip yourself doing too much analysis. That's the biggest problem that you can have, because you can have the right analysis and still get the trade wrong. That doesn't really matter. My goal is to simplify your thought process down to very binary things. Is the market going to be bullish or bearish? Or am I leaning bullish or bearish? Binary, okay? Don't try and overthink it. Don't come to the markets and, last night you did your analysis and you're bullish. By the time you get to the charts, now you're bearish. That doesn't make any sense. Be rigid in that approach, where you're going to come up with your direction, pre-session. You might do a pre-session, you might do it the day before. Order flow, it can be as simple as, is the market fair one another? Is it taking out old highs or old lows, or is it respecting old highs or old lows and moving in a specific direction? So as long as that order flow is moving one direction, then we can obviously stay on sides. So that is our daily bias down. It doesn't really matter how you come to that conclusion. Every trader, professional trader out there really just has an opinion. And what we're doing when we come to the markets is we're expressing that opinion. I might be wrong some days. You might be wrong some days. I might be right some days. You might be right some days. That's not the differentiating factor between profitable traders and unprofitable traders. The differentiating factor is, do I have a process that I can consistently follow day in, day out? And that's the whole point of this video, is providing you guys a process that I was able to follow regardless of the P&L fluctuating on the screen. And when we get into the examples, you guys will see that this scenario plays out a lot. So once you have a clear daily bias, play out more often than not. And that's what we're trying to focus on, is the higher probability trades. So when it comes to execution, one thing that I'm going to note that you should know about is the Asian range. Now, the Asian session, obviously, is a different time zone. So the Asian session, the Asian market is from 8 p.m. till midnight. So that's our Asian session. And when it comes to studying index markets, we want to use that Asian session as our liquidity. So when we're bullish, and we're going to get into the examples with clear examples and executions. When we're bullish, the most likely reason that they would take out the Asian range lows is because they want to manipulate traders to thinking the market's going to go lower, and then they're going to position themselves long before they take it higher on the day. So very simply put, when we're bullish, we want to see a rate of the Asian range low. So just think that there's these traders in Asia that they're trading actively during Asia, the index markets. Well, what's going to happen when we take out their stop losses? Let's say if they're long, stop losses going lower. Well, that might induce new sellers into the market, but it's also taking them out of the market. So if we're long early, we're taken out of the market. Now, what we want to do is just position ourselves on the opposite side of their trade and go long when they're getting stopped out. All right, that's the logic behind this trading strategy. So after we get a rate on the Asian range low, we just want to enter the market long between 9:30 and 11. And when I get into the examples, you're going to see that you don't need an entry confirmation when you're doing this. You can simply put a limit order if you wanted to as soon as we take range. And all the examples that I've drawn are using that assumption that we're going to enter the market as soon as the Asian range is being rated. And then we're going to use, so the other incorporate is the standard deviation. So what is the standard deviation? Basically, you're just going to take a multiplier of the Asian range and you're going to drag it down, and like a rubber band effect. When we pull it back too far, it's usually going to snap the other direction. So when the market is bullish, there's only so far that the market can go lower before it turns around and reverses. So that's the principle behind using a standard deviation, is when it starts hitting those outer ranges of the market, we're just assuming that the market can't go any further on that specific day because we have a underlyingly bullish premise and we go too far below that Asian range low. So our stop loss we're going to use is just -1, -2, or -3 standard deviations as a stop loss. Now, all of the examples that I'm going to show is just using a 1 standard deviation stop loss. Now, if you're entering in the market, when you sit down in front of the charts, you might use a different one based on how that market is trading. All right, and then our take profit is going to be the Asian range or a positive standard deviation. So let's get into the examples. And this is an example of just 3 days in a row where this setup has panned out. So I'll do exactly what I'm looking for. So here we have our Asian range, and now this is September 11th. This is our Asian range, so from 8 to midnight. And then let's just assume that we're going to enter the market around 9 a.m. after we sweep the Asian range low. Now, you could have entered it as soon as we took out the Asian range low at midnight, but if you're not trading at midnight, then obviously we're just looking to trade within that AM session kill zone. The assumption that we're going long at the Asian range low, and then we put our stop loss at 2 standard deviations. Now, why did I use 2 standard deviations? Well, because we possibly are going to run out the previous day's low. Now, we've already traded to the 1 standard deviation. And that's why if you see the market we've taken out the previous day's high, this is kind of where you're going to have your journal or figure out which stop loss you're going to use. It could be 1 standard deviation, 2 standard deviations. You might take a loss on a specific day, but we're only trying to get in sync with the higher time frame order flow. So after we've taken out the Asian session low, this is just under the assumption that I've entered the market as soon as we take out the Asian range low, and then I put my stop loss either at 1 or 2 standard deviations. Now, if I used 1 standard deviation, I would have taken a loss, but the analysis was wrong? No, it doesn't. I would have gotten the trade right if my stop loss was in the right spot. And this is where you can possibly drop down to the lower time frames, and if you want to wait for further confirmation, you can. Go ahead. But if you're trying to make this as simple as possible, we're just going to say that we're going to enter as soon as we take out the Asian range low, and then put our stop loss either at 1, 2, or 3 standard deviations. Now, this trade in itself, you could either have our exit at the Asian range high. So even if we got in lower, let's say we took after it hit the 1 standard deviation, we might have entered, and then we could take our profits at the high of the Asian range. Or we could take our profits at 1 standard deviation, or 2 standard deviations, or 3 standard deviations. You guys can see that all 3 of those levels were hit. So this one was hit, as well as this one. Now, let's say you took a loss on the day, that's fine, or you took a win. If you had a win, that's 2R. All right, great. So 2R on this day. Second day, we're doing the same exact thing. If we were bullish, we're going to go long as soon as we take out the Asian range low, and this was right around 9 a.m., 10 a.m., 11 a.m., right around that area. So if we're going to get long right below the Asian range low, that's fine. We're going to put our stop loss at 1 standard deviation, and we've gotten 1 to 2 out of this trade. It's possible you could have gotten a 1 to 3 if you used the 2nd standard deviation up here, but that wasn't hit until the following day. So we're just assuming that we're just day trading here. So here we got another 2R. So that's 4R. And if you took a loss, then you're up 1R. That's fine. You're still up on a week. The third trade, same exact process. And this is where it's almost dummy proof. We don't need to overthink what we're doing. If we're bullish biased, we want to just buy it below the Asian range low and use one of these standard deviation levels as our stop loss. And the standard deviation, if I were to take this Asian range and just copy and paste this 1 time, 2 times, 3 times, this Asian range, right, should line up with all the Asians. So on the third day, what we're doing is taking out the Asian range low. We're going long, market order. Our stop loss is at 1 standard deviation, and then our take profit 1 standard deviation or 2 standard deviations. So if we used 1, the first level, this would have been a 1 to 2, but if we used the second level, this is a 1 to 3. So you guys can see that 3 days in a row, right? The result of this is 7R, right? And let's say if you were bullish on these days, this day, you would have went long, right? Your stop loss would have been at 1 standard deviation. Maybe your take profit is at 1 standard deviation or 2 standard deviations. You guys can see that these Asian range deviations work very, very well in a trending market. And this is basically exactly what I did to get to pass top step in 2 trades. So if we're bearish, obviously we're going to do the opposite, is wait for the rate on the Asian range high and then enter market short between 9:30 and 11. And we're going to use a positive 1, 2, or 3 standard deviation. And then our take profit is going to be an opposing end of the Asian range or a negative standard deviation. So I'm going to show you guys an example where we possibly would have taken a loss. And right, this all depends on where you're going to put your stop loss. Maybe you wanted to give yourself room for the trade to breathe, so you're using 2 standard deviations, or you wanted to wait for this market to actually turn around and show you that it wants to go lower. Because if you waited after this candle started rejecting this 1 standard deviation, the structure shift on this lower time frame, this is a 1 hour, these are 1 hour charts, by the way. So when you're in the markets and you're seeing that the market's opening and we're trading at 1 standard deviation, then maybe you want to come into the lower time frames and wait for some market structure shift lower, right? Maybe a breaker, etc. To get when, let's say your short entry is here and this 1 hour candle is closing, now it's already moving in your favor. So either you would have taken a loss on this trade or you would have made 2R. The 2R actually would have been, it would have came overnight. So your best scenario might have been like 1.5R, if you were targeting just the opposing end of the Asian range. So after we're taking out the Asian range high, you might have just taken out the Asian range. Following day, bearish bias, right? Just based on this previous day's price action. We're going short at the Asian range high. Our stop loss is again at 1 standard deviation, and maybe our take profit is at 2 standard deviations. So 1, 2 standard deviations hit. So let's say if we got a win on the first day, second day, third day, loss on the fourth day, win on the fifth day. So over 5 trading sessions, this results in 9R. Now all these examples just occurred within the last week or so. So I urge you all to take this process and go and backtest this in the live markets, or go and backtest this using index data on NASDAQ or S&P, or even Forex pairs. Go ahead and test this theory and find out how many trades pan out in your favor, where you've just entered at the market regardless of confirmation, used one of those standard deviation levels as a stop loss, and let the market pan out mechanically. Market orders were basically hands off and letting the trade do what it needs to do. Now, these are just extremely clear examples where you don't need to use a whole lot of information, right? We're just using the Asian range, and we're just using daily bias. So we only have 2 moving parts, and we possibly might get 1 or 2 of those wrong on any given day. But at least you're dialing it down to 2 moving parts rather than, say, 4. Right? Let's say we're going to start incorporating fundamentals and news releases and everything else that's in between that might drive you crazy when it comes to time to sit down, analyze the markets, and actually execute in the markets. And the whole point of simplifying things is that it reduces the load of mental stress that you have. It reduces the load of work that you have to do when it comes time to analyzing the charts. And then it just comes down to you trusting in the analysis that you're doing, and then the probability outcome. Because there's no way that you can control if this market's going to respect these specific standard deviations. More often than not, though, when you're going back through your data, and let's say you entered a short, maybe you got stopped, at the end of the day, you're going to know if that analysis was right or wrong. Because if I just one of these examples, let's say if I got stopped out using the first standard deviation, well, I would have seen that, well, maybe the second standard deviation stop loss would have, that's fine. But if I'm sticking to a 1 standard deviation stop loss, I'm going to make that back on the following days. So let's say you took 1R loss here, and then you made 5R the following 2 days. Will you not be happy with that? Overall, you have 4R results in just the span of 3 days. That, in my opinion, is really, really great. Same thing here. Let's say you took a 1R loss here on this day, but then following that same exact trading process, the following day, you made 3R. So overall, you're at 2R. Who wouldn't be happy with those results? Week in, week out, day in, day out. All right? Now, let's get into how you would journal these trades. Extremely simple. The goal of this video is to help you guys get funded very simply without putting too much thought process behind it, and getting you guys to detach from the outcome. Losses. You're going to have losses using this system. You're going to have losses using any system out there. But when it comes time to execute in the markets, you have to be okay with the decisions that you're making, with the analysis, and then with the result that you're getting. So, did I get the daily bias correct? So, if you were to go back and look at the trade results that we might wrong, doesn't mean we got the daily bias wrong. We had the daily bias correct. It's just the market did not agree with us. So that is a positive. So if I got the daily bias correct, that is still a positive journal. Did I follow my trading process? Yes or no? So that's waiting for that Asian range to be tapped. If I'm bullish biased and we don't see the Asian range be taken out and I enter long anyway, I'm clearly not following the process. I say take profit that is not one of the standards, I'm not following the process again. So this strategy becomes very simple to understand if you're following a process or not. And what I did here was try to break things down to just 2 moving parts, okay? Daily bias and then execution. Don't worry so much about all the analysis you have to do in between with liquidity pools, fair value gaps, order blocks. None of that stuff. You don't really need it when it comes time to execute in the markets. Because of the day, the market is either going to go up or it's going to go down. Did I follow my process? Okay. Then finally, did I manage my emotions properly? If I took a loss, am I able to get up from the charts and walk away? Clear and simple. Now, when it comes to a trading checklist, very easily, we're down. Choose one. Trading checklist, wait for Asian range sweep, obviously. Use standard deviation levels for stops and targets, and then journal your results and feelings. So I only have 4 steps to follow day in, day out. And if you do it this way and treat your trading in as simple a manner as possible, I guarantee you that you're going to have results and compounded results and results that you can be happy about and proud about without spending too much time and pulling your hair out, trying to learn new things, trying to get the perfect entries. Really just come to the markets, have a plan, have a checklist, and execute in the markets. If you find yourself still struggling with trading and want direct guidance to get fully funded with prop firms, just like my student Dom, who maxed out Top Step and just had an $11,000 day, then make sure you book a call using the link in the description. I walk my students through everything that's required to become a full-time trader and provide direct support for them in their trading journeys. That includes trading live with them, reviewing the journals, and answering any questions that they might have. Also, don't forget to like, comment, and subscribe, and I'll see you guys in the next video.